These videos will be added to the educational stuff that I got going on. This is material that I created kind of to, if I would go back to the beginning and give myself the stuff that I felt like was important to reach the level that I have reached now. And I normally was sending this out as like a PDF, but I'm going to create a couple of videos just reading it out and kind of breaking it down. So 9 questions. This is the first thing that I created, and I got some other stuff. So this will be the first couple of videos into the stuff that I was sending as PDFs. 9 questions to ask about trading. What is futures trading? Futures trading is about buying and selling contracts that agree to trade an asset at a set price on a future date. The basics of futures trading. Futures contracts, an agreement to buy or sell something like gold, oil, or stock index at a specific price on a specific date in the future. Why trade futures? Hedging. Businesses use futures to lock in prices and protect against price change. For example, a farmer might sell futures on their crops to secure a good price before harvest. Speculation. Traders use futures to bet on price movement to make a profit. They help to buy low and sell high, or sell high and buy low. And that is what I do, and that is what this is primarily about, speculating and trading, finding the best times to get in and get out and things like that. Um, Leverage. You only need to put down a small part of the total contract value called margin to trade a large amount, which can lead to a bigger profit or losses. A broker that gives a 1 to 5 margin means for every $1 you put up, they will be putting up 50. And this is what a lot of people use as far as trying to grow accounts, and that's why a lot of people like using places that have the margin, because you'll be able to get access to more capital compared to what you're putting in. And with the futures, it's regulated and all that, but they have other institutions that aren't as regulated and offer higher leverages. Settlement. Physical delivery. Sometimes the actual asset is delivered when the contract expires. Example, farmers delivering on whatever commodity they have. Cash settlement often is just a price difference that is paid out. Daily adjustments. Your account is adjusted daily based on the market price, ensuring you have enough margin. And again, with that margin, that's when you get things called margin call. If you place a position and it goes against what you thought would happen, and then you lose the money in your account, it'll liquidate you, meaning it'll close out your account. Or if you have a larger account, sometimes they will call you and say, hey, we need more money, otherwise we're going to liquidate your account. Regulations. Futures markets are regulated to ensure fair trading and protect investors. And this is what I was talking about earlier when I was saying, like, as far as some of the regulations and people transferring over, or some accounts that offer more leverage might be not as regulated as something that only offers 50 and things like that. I know that was a big thing from switching up from Forex to futures with a lot of people. Example, if you think the price of gold will go up, you might buy a futures contract at $1,800 per ounce. If gold goes up to $19 per ounce, you can sell the contract for a profit. If it goes down to $1,700, you incur a loss. Again, going back to that liquidation and things like that. Now here's other pros and cons. Leverage. You can contract large positions with less money. Liquidity, easy to buy and sell contracts because it's on a platform, which gives you more capital. and diversification, you can add this to verify a variety to invest in to your investment portfolio, meaning your long terms, your swings, and your day trades or whatever like that. Once you get to that skill level, the cons: leverage risk can lead to a significant loss. Again, what I was talking about, the liquidation. Sometimes you think you over leverage and then you lose more than you want, or you can lose your entire account. Volatility. Prices can change rapidly when they trade, especially on news events and things like that. You have to be prepared and you have to be ready for those things. Complexity requires good knowledge and risk management, and that's with anything, but especially when it comes to trading, because it is harder and because the risks are higher and not as many people are consistently successful at these things. You have to be able to understand what you're doing fully to be able to be fully productive, profitable, and consistent. In summary, futures trading can be a powerful tool for making profits or protecting against price changes, but it comes with significant risk. I'm going to break these videos up because I don't want this too long. I won't be able to people to be able to digest it bit by bit. So that's it for this video. And that was question 1.